For most people, investment is a must if they want to have a secure financial future. As the coronavirus epidemic proved, an apparently steady economy may be turned on its head in an instant, leaving individuals who were unprepared for difficult times scurrying for money. What are the greatest investments for investors to make this year, with bond and CD yields so low, some assets at astronomical values, and the economy battling with rising inflation? One strategy is to invest in a combination of safer and riskier, higher return investments. Hello everyone, and welcome to Maatins Vids. In today's video, we'll be discussing 10 best investments in 2022. Why invest? Investing may give you with a second source of income, help you save for retirement, and even get you out of debt. Above all, investing helps you achieve your financial objectives by growing your purchasing power over time. Perhaps you've recently sold your home or received a windfall. Allowing your money to work for you is a good option. While investing can help you develop money, you must weigh the benefits against the risks. And you'll need to be in a financial position to do so, which means you'll need to keep your debt under control, have a sufficient emergency fund, and be able to ride out the market's ups and downs without having to use your funds. There are a variety of investment options available, ranging from extremely safe options like CDs and money market accounts to medium risk options like corporate bonds and even higher risk options like stock index funds. That's fantastic news, since it means you'll be able to select investments that provide a range of returns while still fitting your risk profile. It also implies that you can mix and match investments to construct a well-balanced and varied, and hence safer, portfolio. Number 1. High-yield savings accounts. On your cash balance, a high-yield online savings account gives you interest. High-yield internet savings accounts are accessible vehicles for your money, just like a savings account earning pennies at your local bank. Online banks generally provide substantially higher interest rates due to lower overhead costs. Plus, you can usually get your hands on the money by transferring it to your primary bank or via an ATM. For people who will need cash in the near future, a savings account is a suitable option. Number 2. Short-term certificates of deposit. Banks issue certificates of deposit, or CDs, which often pay a greater interest rate than savings accounts. When rates are expected to climb, short-term CDs may be a better alternative, allowing you to reinvest at greater rates when the CD matures. The maturity dates for these federally insured time deposits might range from a few weeks to several years. Because they are time deposits, you can only take the money out after a certain amount of time has passed. The financial institution pays you interest on a CD at set intervals. When it matures, you will receive your initial principal plus any interest that has accrued. It pays to browse around for the best deals online. CDs are a wonderful alternative for seniors who don't require quick income and can lock away their money for a while because of their safety and larger returns. Number 3. Short-term government bond funds. Government bond funds or mutual funds are exchange-traded funds that invest in debt securities issued by the government of the United States and its agencies. Short-term government bond funds, like short-term CDs, don't expose you to much danger if interest rates rise, as they are predicted to do in 2022. The funds put their money into U.S. government debt and mortgage-backed securities issued by government-sponsored firms like Fannie Mae and Freddie Mac. These government bond funds are ideal for investors who are looking for a low-risk investment. These funds are also a fantastic option for new investors and those looking for a steady stream of income. Number 4. Short-term corporate bond funds. Corporations may raise capital by issuing bonds to investors, which can then be pooled into bond funds that own bonds issued by dozens of different companies. The average maturity of short-term bonds is 1 to 5 years, making them less subject to interest rate swings than intermediate or long-term bonds. Investors searching for cash flow, such as retirees, or those who wish to minimize their overall portfolio risk while still earning a return, can consider corporate bond funds. Number 5. SP 500 Index Funds. An SP 500 index fund is a wonderful option to more typical banking products or bonds if you wish to attain larger returns, albeit it does come with increased volatility. The fund is made up of around 500 of the largest American corporations, which means it includes many of the world's most successful businesses. Amazon and Berkshire Hathaway, for example, are two of the index's most notable members. An SP 500 index fund, like practically any other fund, provides rapid diversification by allowing you to hold a portion of each of those firms. Because the fund invests in companies across all industries, it is more resilient than many other investments. Over time, the index has averaged a 10% yearly return. These products have low expense ratios, the amount the management business costs to run the fund, and are among the best index funds available. Because it provides wide, diversified stock market exposure, an S&P 500 index fund is an ideal alternative for new investors. Number 6. Dividend stock funds. Stocks that offer dividends might make your stock market investments a little safer. Dividends are portions of a company's profit that can be paid out to shareholders on a regular basis, usually quarterly. With a dividend stock, you'll not only get a return on your investment over time, but you'll also get paid in the short term. Individual stock purchases, whether they provide dividends, are best suited for intermediate and advanced investors. However, you can limit your risk by purchasing a group of them in a stock fund. Number 7. Value stock funds. Many investors are unsure where to place their money in light of the recent run-up in many equities, which has the potential to lead to severe overvaluation. Value stock mutual funds could be a smart choice. These funds invest on value equities, which are less expensive than other companies on the market. Furthermore, when interest rates rise, as they are predicted to do in 2022, value equities perform better. For many investors, the fact that many value stock funds pay a dividend adds to their appeal. Number 8. Nasdaq 100 Index Funds. Investors who want exposure to some of the biggest and greatest tech companies without having to pick winners and losers or evaluate specific companies can consider an index fund based on the Nasdaq 100. The fund is based on the Nasdaq's top 100 companies, which are among the most successful and stable in the world. Apple and Facebook are two such corporations, each accounting for a significant share of the total index. Another notable member firm is Microsoft. A Nasdaq 100 index fund provides immediate diversification, ensuring that your portfolio is not vulnerable to a single company's failure. The top Nasdaq index funds have a low expense ratio, making them a low-cost opportunity to hold all of the index's companies. Number 9. Rental housing. If you're ready to manage your own properties, rental housing might be a terrific investment. And, with mortgage rates still around all-time lows, now could be an excellent moment to finance the purchase of a new home, even if the uncertain economy makes running it more difficult. You'll need to pick the perfect property, finance it or buy it outright, maintain it, and deal with tenants if you go this path. If you make wise purchases, you can do very well. You won't be able to buy and sell your assets in the stock market with a single click or tap on your internet-enabled gadget, though. Worse, you might have to put up with the 3 a.m. call about a burst pipe. However, if you hold your assets for a long time, pay down debt gradually, and increase your rentals, you'll most likely have a strong cash flow when it's time to retire. Number 10. Cryptocurrency. Cryptocurrency is a type of electronic-only digital currency designed to be used as a medium of exchange. It has become a popular item in recent years, as investors have poured money into the asset, driving up prices and attracting even more dealers to the market. Bitcoin is the most extensively used cryptocurrency, and its price varies dramatically, drawing a large number of traders. For example, Bitcoin climbed from under $10,000 per coin at the start of 2020 to about $30,000 by the start of 2021. It then doubled above $60,000 before reversing course. However, cryptocurrency had a difficult start to 2022, with traders selling their positions in droves and most of the leading cryptos plummeting. However, many cryptocurrencies, such as Bitcoin, are nearing all-time highs, and it's not uncommon for them to have significant price fluctuations before climbing further. Despite the ups and downs, those that purchased and held may still be sitting on some fairly substantial returns. It is not backed by the FDIC or the money-generating power of either a government or a firm, unlike the other assets listed here. Its value is totally defined by what traders are willing to pay for it. I hope you find this video helpful. If you like the video, please like and subscribe as it really helps our channel, and remember to give your feedback in the comments below. See you in the next video with some more interesting topics and facts.